welcome to this Astranti YouTube video on expected values. This is a very important topic, particularly for any subject relating to a risk, so particularly your P2 exam. And it's my hope that by the end of the video you'll understand what an expected value is and why they are used, and also how to calculate the expected values. And if you like this video and you want to see more, then please like and subscribe at the bottom. We're going to be releasing lots of different videos relating to specific topics, but also to exam technique, be that objective test or case study. And also visit the website www.astranti.com for more information and more free samples. So what is an expected value? Well, it's a way of essentially assessing risk and accounting for risk, because it involves looking at the potential outcomes and assigning a probability, and then finding a total value based on the weighted outcome of these probabilities. And it can be used to compare two different projects side by side, which appear to have very different figures, but it gives you a figure that you can use, a tangible figure that you can use to really compare the two side by side. So how would we go about calculating an expected value? Well, it's a three-step process. The first step is to assign a probability to each outcome. So you think of several different outcomes that could happen as a result of launching this product or undertaking this project, whatever it may be, and you assign a probability to the best, the most likely, and the worst outcome. Once you have defined those outcomes, you define the expected value by multiplying each outcome's value by the probability, and the final step is to calculate the total expected value by adding together the different individual expected values. So let's look at an example of how this works. And I want you to imagine that we're working for a company that is producing toys, and we're considering launching a new range of toy cars that have a selling price of £100 per unit. And we have calculated our probabilities of our best, most likely, and worst outcome. So the worst possible outcome is we'll only sell 50 units. The most likely is that we'll sell 75 units, and the best possible outcome is to sell 100 units. And we've got the probabilities here. So the first step that we need to do, we've already done, because that was to assign a probability to each outcome. The second step is to find the expected value of each outcome. And the first thing we need to do for step 2 is to calculate the outcome value, which we can do by multiplying the number of units sold by the selling price per unit to give the outcome value. So 50 units multiplied by £100 is revenue of 5,000. 75 multiplied by 100 is 7,500, and so on. And then we multiply that by the probability to get the weighted outcome. So, for example, we would multiply 5,000 by 0.2, and that's to take into account the fact that that outcome is far less likely, so it should have a lower weighting. So multiply the revenue by the probability to get the expected value. So 0.2 multiplied by 5,000 is £1,000. Repeat the process for the second outcome, so that's 0.7 multiplied by 7,500, and that's £5,250. And repeat the process again for the best possible outcome, which also gives an expected value of 1,000. Add them all together for step 3 to get our total expected value, which is £7,250. So that is the expected value of this project. And that can now be compared with other projects. So if there's another project with an expected value of 6,000, we know this one's better. If we have another project with an expected value of £8,000, we know that one is better. But a few things to be aware of. It is the weighted average of expected outcomes. It doesn't mean that's the most likely outcome. It doesn't mean this project will generate revenue of £7,250. The most likely outcome is still that it will generate revenue of £7,500. It's just when you take into account all the potential outcomes and the probabilities of those outcomes, that's the weighted average of the expected values. And that's what you use to compare projects, and the one with the highest expected value is the best outcome. So hopefully now you have a good idea of how to calculate expected values. It's quite a straightforward calculation, but what is also important is you know how to use it. Why you would use that expected value, how you would compare projects using the expected value. And hopefully now you know why we would do that. So thank you very much for watching this very short video introducing expected values. If you have liked this video, please like and subscribe at the bottom, and visit the website www.astranti.com for more information and more samples.